So if you look at, there are two parts to it. One is, of course, you really need to look at maybe in terms of economy, how we are really doing it. Okay. And what sort of impact this war would really have. So if you look at closely, it's not like maybe we really are so dependent on Russia and Ukraine, and we really have a strong ties in terms of maybe in terms of number or maybe exports and import number that I'm really talking here. Uh, you the total export and import and dependencies related to it is not beyond 1.5% in terms of the either you look at exports and import both. Yes, there are worrisome part which is actually resulting in terms of the higher inflation arising from the crude and the global commodities, the way it has really panned out. And to that extent, India will really have an impact. Okay. And if I just have to quantify, maybe perhaps I would really say uh, if we continue to have crude closer to around 110, then maybe for a year inflation could really move. Maybe if it was expected to be around 5.5, it can really move around 6.5. So the delta that in terms of our impact because of maybe the higher crude that you really see in terms of inflation is closer to around 1%, which includes direct as well as indirect impact. Perhaps market at this juncture is actually looking at that this segment or this type of problem should really end somewhere around maybe next 2 months, and hence the problem maybe 2 months or 3 months down the line should really start getting better. The third wave and the fourth wave, we have not really seen the impact, and that is really a big stuff. So clearly you have a fear, and to a rightly to right extent, maybe perhaps arising because of the US-Russia conflict and the inflation. But there are something which is also good happening in the economy. You look at manufacturing numbers, it is really getting better day by day. You look at maybe perhaps the services. We have just seen maybe some of the company have really reported in last few days, banking companies I'm talking here, they have reported their credit growth. The pickup in terms of maybe sequential credit growth is close to at least maybe on an average around 5 to 6%, and which basically means it is sequential number. So if you annualize, it's somewhere around maybe 18 to 20% on basis. You can safely assume, which basically means March has actually been quite good in terms of the credit offtake. And if we are actually talking about credit offtake, it also means that maybe, okay, the economic activity has suddenly started picking up in India. Just to case in example, there could be maybe sectors like we have seen aviation and the travel related services, which is like either maybe hotel and tourism and travel. They have been impacted for last 2 years. Okay. And what we are seeing currently is stupendous growth. And this growth looks like is going to go on at least for maybe next 1 year. And there are certain parts, which is like India has started, in fact, exporting more, maybe in terms of metals, mining, and the other stuff as well. So the manufacturing is getting better. There are segment of the market, which is, of course, really giving a relatively better desired result. But at the same time, there are pockets where maybe we would really have some bit of impact, which could really be either consumption related thing because inflation has gone up, raw material prices has gone up, and hence we could really see some bit of impact in terms of margin. But overall perspective, I think this is only a very relatively a small pocket, maybe around 15-20% of the total component of Nifty. And that is why we are actually having a reason at this juncture that in spite of the global sell-off and the global problem that we really see, India is relatively better placed. We have one worry at this juncture, and the biggest worry is, of course, crude. We can handle crude closer to around 100. If it really moves beyond it, yes, it's going to be a big problem and big setback. Maybe banking and finance is one of my favorite sector, and I give you a reason, three reasons. Credit growth picking up. The credit cost is behind us in terms of the worst credit cost that we really have seen in last 5 to 7 years. And the third one is, of course, if you are really having a rising interest rate situation, so that typically bodes well for NIMS expansion, the margin expansion for them. So these three things would really ensure that maybe, okay, we get better. in terms of maybe the sector call. Also, when I'm talking here, I'm also having a background that banking and finance per se has not really done phenomenally well in last 3 to 4 years. So the base, it's not like either in look at in terms of valuation or look at in terms of maybe the number that perhaps that they've delivered. It's on both front you would really have a surprise. So I guess this is one of maybe a favorite at this juncture, maybe when I'm looking at from the 1 year perspective. The second could really be tourism and travel related segment where we are seeing very good momentum. The third could really be in fact automobile as well. And the reason perhaps, yes, they are going to be impacted because of the inflation and the commodities prices going up. But at the same time, if I really look at the growth in that segment was not really much because of number of our regions that we really have seen in last 1 2 years. Okay. So clearly, we would really start saying either in terms of the chip shortage getting eased out as we really move on, and then the number that we would really see a far better. Also, these guys are actually have been taking a lot of price increases. And somewhere down the line, I really hope that commodity price is not going to just continue to go up. So if it just maybe stabilize or it really starts coming down, then these guys who have already taken a price hike could really be a major beneficiary. So for me, I would say this is one segment where maybe perhaps I would really go contrary to the market expectation, although the number at this juncture is not really looking exceptional, but I think there is some bit of surprise could really emerge, especially towards the second half of the year. Uh, the third, on the similar line, I would say cement is what, as a sector, to me looks like a very a segment where we have started seeing some bit of price hike. There is commodity pressure or price pressure that may be inflationary pressure that we really have been witnessing. But I guess they're also in this on the similar line that perhaps as we really go on, these guys would really be able to take the price hike, and hence maybe relatively the second half should really be better off. The fourth segment, of course, I really like is the commodities related segment, because I see that maybe okay, they are the beneficiary of the current environment where a lot of disruption in terms of maybe supply disruption has happened. And then in that context, the prices is going to be either elevated for some time, or even if it really comes down, the cost inflation for them also would really start receding. So all in all, actually that segment also should really relatively be either resilient or should really give maybe some bit of good return in at least immediate first half itself. The fifth one and the last one is telecom. The dynamics in terms of the market dynamics, it has really changed a lot in last maybe a few quarters or a few years. You have almost got a situation which is basically we have become duopoly sort of. Okay, there are the third incumbent player has actually been reduced to a large extent, and hence there is a big pricing power which has actually emerged to these two guys. And that's something which is good for from the investment perspective. To avoid, I would really say that maybe perhaps consumption related segment, and especially in the first half, okay, should really be avoided. And the reason is pretty simple that the inflation, what we are really going to witness in next maybe a few quarters, maybe this quarter and the next quarter is going to be something that maybe we have not really seen, and it's very difficult to predict as well. So there could be a lot of negative surprise could really come in that segment. I mean here in consumer staples or consumption staples, or maybe anything which is the white goods market, where we also could really see a lot of inflationary pressure coming in play. And that's the reason for me that would really be a sector where perhaps at least for next 6 months I would completely avoid it.